Today, let's look at how to calculate trade costs along the timeline. Trade costs start at time D, the moment when portfolio manager makes the decision to buy or sell assets. So, the asset price at this decision moment is denoted as PD. The portfolio manager needs time to choose which trader to give the order to. So, when the trader releases the order to the market, the asset price may have already changed. This new price upon release to the market is the arrival price, denoted as P0. When the order is finally executed, shares within one order may have been bought or sold at different prices. So, the execution price is denoted as PJ, meaning that the execution price may be different for each share transacted. When trade costs are being calculated, the current market price is denoted as PN. The first cost incurred is the delay cost. This cost happens when a portfolio manager wants to buy some shares, and if the share price has increased before the trader could send the order to the market. This means that it will now cost more for the manager to buy the same amount of shares. This increase in price between the arrival price and the decision price is a cost to the manager. The delay cost also happens when the manager wants to sell shares, and arrival price is lower than the decision price. This means that the shares have dropped in price and the manager has incurred a loss. The formula for delay cost calculation is simply the difference in price multiplied by total number of shares transacted. The second type of cost is trading cost. It is the difference between the execution price and the arrival price. Notice that here the execution price may be different for each share, so we do the sum of the products of number of shares multiplied by the execution price, instead of the sum of shares multiplied by one single price. The sum of delay cost and trading cost is execution cost, which covers all costs incurred due to price fluctuation between the decision moment and the trade completion moment. Execution costs are all about shares that have been transacted. For parts of the order that could not be completed, the incurred costs are called opportunity cost. Opportunity cost compares the current share price to the decision price. So, again, if the asset manager wants to sell shares, he will incur an opportunity cost if he is not able to sell the shares and the shares have dropped in price between the decision time and the current time. Implementation shortfall is the sum of execution cost, opportunity cost, and other fees incurred during the trading process. Notice that execution cost and opportunity cost may be positive or negative. In the equation, when shares are being bought, the share numbers are positive. They are negative when shares are being sold. So, depending on how prices fluctuation and depending on which side of the transaction we are, the implementation shortfall equation may give a positive or negative number. If the number is positive, it means it is a cost and the portfolio manager has incurred a loss through the trading process. Thanks for watching today. Happy studies and see you next time.